I was thinking about what question I really wanted an answer to from this panel. And, really the question I'm wondering is where crypto is at today. What is the story around this sector? And the thing I thought about more and more is it's really hard to answer that question without acknowledging where we were 1 year ago, which was a very different place. I'm not going to go through the numbers. They're pretty gory, but things are down. We know that. Everything's down. So, Ayesha, I want to start with you. Given what we know now and after the events of the past 6-8 months, what do we know today about crypto that we didn't know 1 year ago about the sector?
So I think one thing for sure is that it's one alternative asset that isn't going to go away. And every single time there's been a crash, and crypto has had, historical crashes over the years, like we're very immune to it at this point. But we always said Bitcoin won't survive or the entire economy won't survive. Right now, we know that there's enough interest, there's enough dry powder on the sidelines, and there's enough development going on in the entire sector for crypto and blockchain as a tech stack to stay around for longer than anyone else anticipated.
Got it. Ambre, what are your learnings from the past year based on what you've seen?
So I think to echo what Ayesha just said, crypto is here to stay. And one of the reasons it's here to stay is that it is now fueling a lot of real life applications, right? We've seen what's happening with the DeFi. We've seen developments in the gaming world. We've seen a couple of use cases for blockchain. And so when we talk about crypto and we talk around market infrastructure for crypto and all these kind of companies and fundamental pillars of a developing market, we should remember that the crypto asset is pretty much the unit of accounts that is used as an incentivization mechanism for people to maintain and for networks to maintain blockchains. And that should serve a purpose. And now I think it has a purpose, which was pretty much less the case a couple of years ago. Today we're seeing applications. And so I completely agree with what we just said.
Got it. Christine, Ayesha and Ambre focused a lot on the technology component. From a markets perspective, what have you learned about this sector in the past year?
I think one thing that's evident, particularly of the markets today, as opposed to the markets in the past, there was, this propensity to have crypto treated as kind of a side sleeve, and also even positioned as an uncorrelated asset. That is not necessarily the case anymore. We're starting to see crypto also being impacted by global macro conditions, as well as the activities of other markets. So when you think about crypto as being part of a continuum and an investable sleeve of assets, it's actually a good indication that crypto is growing up and being considered alongside other assets as part of traditional portfolio allocation.
You mentioned the correlation piece. When we think about crypto, the extent to which it correlates with other risk assets, does that go for the entire sector? Because there are different, types of. Crypto is a lot. There's NFTs, there's spot, there's derivatives, there's DeFi. Is there a nuanced story here amongst which parts of it correlate more with risk assets, et cetera?
Look, I think there's so much nuance to crypto. You can't treat it as a single entity or it is an asset class, obviously, but there's such tremendous diversity among the assets, no matter, based on the use cases and based on how they are treated and how they are used. What I think it's really restrictive to couch all of it as an uncorrelated asset or a correlated asset. What we've seen now is that the correlation does fluctuate, and right now we're in a period of high correlation, irrespective of the asset, but we see greater correlation with more blue chip crypto assets, obviously. And I would also say that among crypto assets, you're also seeing the infrastructure kind of begin to develop around that is fostering things like greater hedging strategies, pairs trading, quantitative strategies. So you're starting to see lots of market structure that exists in other asset classes be applied to crypto, which was not historically there. We're talking about somewhat primitive infrastructure, high degrees of fragmentation, lack of transparency, irrespective of the underlying blockchain.
Basil, the last year, what have you learned that you are applying now to developing your business?
I mean, besides getting a lot of licenses to do what we're doing, I think we've collected about 7 now. We had two a year ago. Is that it's necessary to sort of find that balance when it comes to regulatory to do what crypto infrastructure companies can do. Because yes, we can offer a trading marketplace, we can offer storage, we can offer payments. But what we're starting to see, which is very different from, especially we've been around since the last downturn or bear market, as people would think about it, 2018, is that corporate appetite has increased a lot, particularly from non-financial corporates to just get involved. They don't necessarily have a point of view on which assets they want to dabble in or get exposure to. In a sense, they'd rather just be involved in the sense of being allowed to have payments. They don't necessarily want balance sheet exposure. For example, the most frequent question I'm getting from, let's say, a resort or a car rental company that comes and says, I want to accept crypto, but I don't want it to hit my balance sheet. Can you help me with a solution? And I didn't think that we'd get questions like this, but we are. And we're actually coming up with a lot of solutions around accommodating those needs, which shows the difference is that even though markets may be down from a pricing perspective, I think adoption overall is increasing across the board.
Can you give an example of how, corporations that are looking to adopt the technology more are thinking more about risk now than they were this time last year?
So the simple example of the payment structure. So everyone that I've spoken to, at least who have appetite in the UAE and MENA for accepting crypto payments, has that same requirement. I want to convert instantly. If a customer comes and pays me to say rent a luxury car or book a hotel room or buy a house, I don't want to sit on the risk. But I'm happy to accept the crypto at point of sale. And that's the thing that we've been seeing a lot of. On the other side of it, oftentimes we're seeing kind of more established corporates, larger ones that have maybe bigger loyalty programs, say, how can we get crypto involved in our loyalty program or NFTs or whatever it is in Web3 or blockchain, because they just want to get in and get involved. And I think oftentimes it puts us in a position where we have the opportunity to guide them, but also to create a custom solution for them.
One of the common threads that connects, I think, all 4 of our panelists today is the fact that each of you have spent a good portion of time in traditional finance before having come to crypto. And so, and I want to go down the line here. Ambre, we'll start with you. There's some commentary out there that, crypto may sort of fall into the same traps that traditional finance fell into over the many decades that it became such a robust system. Ambre, do you think that's the case? Is crypto, is it bound to fall or make the same mistakes that were made in traditional finance? And to what extent can that be prevented?
Yeah, that's a tough one. I think, we should treat crypto, aka blockchain, as an underlying infrastructure, something that offers very powerful tool in how can we execute code, how we can transform what today is mostly contracts, financial contracts between parties, in a new type of underlying infrastructure that enables the 2 parties to leverage a different system. It really reshapes the business model of how we implement contracts between parties, and that by itself is revolutionary. Now, what hasn't changed is that it's people on both ends, and it's easy sometimes to follow greed and follow also short-term interests. And unfortunately, and we've seen that, right? And whenever there's a new technology, a new opportunity, obviously some people try to take advantage of the system. And there may be some cases where we should try to remember history. And I've seen things where we were like, oh, tokenized securities, that's awesome. We're going to tokenize LP token yields, and we're going to, all of that. Like for me, I started working in traditional finance in 2008, just after the subprime crisis burst. And I'm like, guys, let's try to not forget where blockchain is coming from. It really comes from that notion that, you know, we want to have more transparency and we want to decentralize and give more power to code and transparency. But then let's not use that technology to recreate the same more opaque financial products that we had back in the days. And so I think there's definitely a slippery slope there in using the technology to just recreate in a probably more efficient way in terms of how the costs are spread out across the value chain. But let's not just recreate problems that we know will happen. So that's definitely a bias we should be very much aware and careful of.
Christine, how do we avoid the same sort of issues around leverage and risk that have come up in traditional finance?
Look, I think Ambre brought up tremendous points here. What we are seeing is human frailty around emerging technology. At its core, we're talking about a very powerful set of financial tools, set of tools that can be leveraged in many different ways. You're also talking about applying that to an industry that's relied almost exclusively on things like contracts and ISDAs for how it functions. So you can't expect a sea change like that to happen overnight. So we will see continued transformation. I do think that DeFi and crypto will sit alongside traditional financial infrastructure. But I also think that you're right. I mean, what is at risk here is applying the same type of regulatory rigor that eliminates the creativity and the innovation from what is truly unique about blockchain technology and how we can leverage that as an innovative financial tool. That's really the fear, and the fear is kind of beginning to eliminate some of the bad behavior. The bad behavior should be regulated, should be regulated away. Crypto, as part of its growing up, really does need to have appropriate risk frameworks where we understand kind of basic things like counterparty risk. You can't have collateral pledged to multiple obligations. That's just, that's not innovative. That's crime, so.
Yeah. I 100% agree just on Christine's point on risk. I think that is one metric that is completely overlooked in crypto. Yeah. You know, people jump from one like APY, like whatever is the highest yield paying pool from one to another being driven by profits without considering the risk involved. And in some ways, the major hacks we see, the major protocol hacks, I think are like, a little reminder that we are in a world with a lot of risk and that this should be a metric that we should monitor.
But then that's why, so first of all, crypto trades exactly the way stocks were trading like early 90s or like mid 80s. And the traditional funds that are currently involved have made their money in TradFi to be very appealed by crypto, right? Because when we discuss strategies with them, we say that, look, we're bringing the same set of book that, our PMs were trading like at UBS or Merrill Lynch, and we're implying the same principle. It's just that crypto has been more volatile because it's very inefficient. Like one bad news, it could be to Ethereum, it could be to CPI, it could be to macro global tension, it could be anything, and 30% drawdown, right? Stocks don't operate that way, like the general traditional markets don't operate that way. But the only reason that crypto differs is the market itself is like one step ahead, right? So like something that Ambre just said, DeFi pools, right? So even if we were to stabilize, like let's say BTC and ETH are very much correlated with, with the broader markets. But then you have like these tiny coins that are somewhat illiquid as compared to, Bitcoin or ETH or like even top 5 on most days. But, they show some sort of uncorrelation. So these are like, these DeFi markets that are basically trading on their own, generating some sort of APYs, to funds like us, not as lucrative as, probably as when BTC or ETH were trading like, last year or so, but generating enough of a return for funds like us to satisfy their LPs. So, and I think that crypto as a whole, as a full-blown industry, has always been one step ahead. Like we've seen in Celsius' case, right? Like he was obliged to pay back MakerDAO and one more DeFi protocol. I'm forgetting the name. Why? Because otherwise he would have been liquidated. No one, almost everyone else had to liquidate him. So that's like the power of DeFi over almost everything else. We're one step ahead on full transparency, like on-chain metrics, very easy to find on-chain transactions. But the more as the technology stack grows, the more we're going to see the larger coins becoming like completely correlated, but then the other ones having their own economies on their own.
Basil, how do we avoid some of that human frailty? Christine mentioned human frailty around emerging technologies. Maybe this is less of a crypto question and more of a human psychology question, but how do we avoid that this time around?
It's a good one, and I think that there's really two areas where I probably spend way more time day to day than I should, which is KYC and AML. This is where I spend maybe 80% of my days. And that's
just define those for people so that we make sure.
To define this, KYC, especially when it comes to corporates and individuals, is to essentially know who the counterparty is. And that's going to the point, part of assessing the counterparty risk in terms of the people within, at least for us, the exchange that are dealing with each other directly, essentially. And having certain criteria, risk ratings, and being able to sort of grow up in a sense is that yes, you lose some of the democratization of access to these kinds of products and these markets, but at the same time, you're also reducing some of the risk. At least that's the intention. Now, is there a better way to do it? Probably, but I think it'll take us some time to figure it out as an industry. On the AML side, which I don't think is spoken about very much, is another layer of risk here, which is the blockchain is very helpful to actually avoid. But it creates new scenarios where actually we spend a lot more time doing tracing on deposits that come in than you would in traditional finance, because we have now new criteria that is agreed with our regulators. Say, okay, if there's an indirect risk, meaning something happened to a wallet or a particular asset that has passed somewhere else, not necessarily with the client we know, that has been maybe tainted, then there's a whole process around investigating that. And that creates a lot more work for at least our team and our operation. But overall, does create a safer environment.
Ambre, when we talk about crypto trading, generally speaking, or just crypto markets, I mean, data is so important to everything that exists with infrastructure. Your entire company is based on providing blockchain data. I mean, give us a little bit of a sense for what pain points still exist as it relates to data and blockchain, because there's, I mean, look, it's a 24/7 market. It's all transparent. It's all there, you know, but then you got to make sense of it. So what pain points are we still trying to figure out as an industry?
So there's two places where you find market data in crypto, right? One of them is crypto exchanges, centralized crypto exchanges, Coinbase, FTX, Binance, Kraken, all of these big companies where the trading activity actually doesn't happen on-chain, right? It's centralized crypto exchanges. They run their own order book. They have matching engines, and it's like it actually operates like a traditional exchange. The only difference is that the assets are crypto. So for that, they have relatively traditional, from a data standpoint, data engines and APIs where you can connect to and gather order book data, quotes, bids and asks, and executed transactions. So here, getting market data for crypto assets trading is actually relatively classic. It's a classic kind of financial data problem, right? That's one part of the equation where it's mostly a technological challenge of knowing that the exchange landscape is so big, fragmented, and global. It's being able to collect in real-time data from hundreds of venues for hundreds of thousands of traded instruments, and being able to consolidate that data, standardize it, make it intelligible and easy to consume by clients on the other side through a consolidated API. So that's more of a technical challenge. Where it is more of an IP and intelligence challenge is getting all of the on-chain data. So on-chain data is defined as any data that lives on the blockchain. So when you think about decentralized exchanges such as Uniswap, for example, they live on Ethereum. If you want to access transactional data from Uniswap, what you have to do is to run an Ethereum node and then read within the blockchain the data. Sounds trivial, sounds public, sounds easy to access. Turns out you don't just read a blockchain like an open book, right? You have to actually make sense of the data. And that is a different kind of challenge. It's not just about kind of high-speed connectivity and data engineering. It's more about making sense of the data and modeling the different protocols and understanding and extracting out the data in order to convert it into a data output that looks exactly like traditional financial data. So that's kind of a different beast to tackle.
Right.
And then on the delivery side, it's about making market data. What we define as market data is liquidity. So actually the orders that are out there, outstanding, all of the buy orders and the sell orders, that's a very important part of market data. If you look just at price and transactional data, it's quite narrow because you don't understand what is the sheer volume of open interest. And that's really interesting because Ayesha was mentioning, those kind of smaller tokens, less liquid DeFi tokens. I mean, sometimes I hear stuff in the DeFi world like, I made 20% on this and that, and I own God knows how many, $100,000 of that. And I'm like, well, actually, there is such little liquidity that if you were to sell, if you were to exit your position, you would take a 40%, if not worse, discount on the price we're seeing, the public price. So the notions of liquidity are extremely important, and that is part of the important data that we're providing to the market. So it's really about what is the liquidity, what's the bids and asks on markets, and then what are the prices at which transactions are executed. Crypto is not unlike any other market. There's price discovery, there's bids and asks, there's offer and demand. And at the intersection of this offer and demand, this is where you have a price, right? So that's what we provide.
Ayesha, we were talking last week about how your firm scrapes on-chain data directly yourself. How do you find yourself making sense of all this data in your own capacity?
So we love Kaiko, and we've known them and been trying to work with them for like a few years now. The issue is that DeFi is, a decent sized portion of the fund. And for that, there is still no perfect tooling out there because DeFi is one market in crypto that evolves at a light speed. So what happens is that we have a couple of PMs and we have a couple of, software engineers dedicated to them that are scraping off on-chain data on time to basically trade the strategies that they want to trade. Now, speaking of, illiquid assets and whatnot, there's a data project out there called Nansen, and they've literally started calling out the wallets that are basically, selling at, at large volumes and, trying to see where is this like market flush or, where is this drainage coming from. It's a tedious process for us. I feel like we've kind of perfected it over time, but we need that for our strategy. And there's still no perfect solution because on how fast DeFi has gone. But just to give you an idea, we trade Dutch auction vaults, and they normally trade on the Eastern hours, they trade from Thursday night to Friday morning. Throughout the night, the traders are trading, and it's all on-time pricing. So no one can provide it. We've had to build internal tooling just to get reference price on point. Even our fund admin, it's very hard to trace it and market. They normally just do bid markets. So just to give you an idea that how far tooling is in crypto at this point to even match up to TradFi, from wherever we look at it.
I'm going to open up the hatches on another topic separate to data, which is regulation, which is so crucial to any discussion about crypto trading. We've got to talk about that. Christine and Basil, I know that these are topics that you all think about. I know Christine and Basil have some strong thoughts on it. Let's talk about regulation. Christine, we'll start with you. The question around whether tokens or securities, that's the number one question. Other than that, what question do you specifically want an answer to from a regulatory perspective?
From a regulatory perspective, what I hope to achieve, or what I would hope the industry would want to achieve, is to create a functional framework. Given the diversity of digital assets and the various use cases, you couldn't possibly have a single prescriptive regulatory framework that would encompass everything and eliminate kind of any unintended consequence.
And what would that framework include?
The framework would include stablecoins, which stablecoins are really, I would view them as a mechanism that allows traditional finance to almost interact with more non-traditional or crypto-native finance. I do think a focus on creating an appropriate, allowing appropriate consumer protection. Like,
right.
We do need consumer protection.
Right.
And a framework that will help, look, I think this is the biggest piece, and this could actually be the accelerant for the next wave of innovation. You have a bunch of traditional finance players literally on the sidelines, fielding teams. They've been working on enterprise blockchain for what seems like decades. They are knowledgeable about the space, but without an appropriate risk framework in which to operate, they're not going to get the resources necessary to employ even proof of concepts that are crypto. Maybe proof of concepts, but they can't live in isolation. It's really important for them to have that kind of roadmap. No one is going to take on that risk without an appropriate framework. And also, I mean, quite frankly, we will see regulatory arbitrage. We're seeing it happen in this country. Like, it is, Basil, tell me it's not happening.
It's happening everywhere.
It
It's
is
happening everywhere.
Exactly.
Yeah. Everyone who's basically operating out of US has an offshore entity, basically.
Basil,
So
over to you.
It's not just that. For example, in the UAE, we've got entities in Abu Dhabi, in Dubai, and then across the GCC, you've got Bahrain. There is active regulatory arbitrage with firms operating in the region. And I think that this is a symptom, I guess, of looking for that perfect fit, which is just not going to happen, especially at an international level. And I think that given how global crypto has become, given how global blockchain has become, is that if there is a certain regulatory framework that is so different from another in another part of the world, it becomes very difficult for, let's say, investors to interact with each other across those borders. And that kind of goes against the original purpose here, which is that global kind of unified financial outlook. And I think that what's important is that the industry actually needs to kind of put its head together and think about, okay, globally, what's the minimum acceptable risk-based view we can take to almost self-regulate? And then from there, use that to sort of influence national or state level regulators around the world in a positive way, to check all the boxes in terms of protecting clients, making sure there's no market abuse, having AML controls, etc. But not being so rigid in the sense that either if it's a risk-based approach that there's a zero risk tolerance, or that if it's a rules-based approach that the rules are so rigid that they don't account for innovation. And I think right now there's that balance just isn't there at a global level.
When you talk about regulations in Abu Dhabi, give us a flavor for what those regulations are like there, how they are more concrete, and how they have helped you set up your business in a way that you might not have been able to in North America.
So I think they're more concrete because we've been at it for about 3.5 years. So the original guidance or comprehensive framework in Abu Dhabi was released in 2018. So we've had quite a few years to work with our regulators, test what works, test what doesn't work, and have that engagement with them to be able to adapt. I think the pace of change may not be as fast as we'd like, but that's because we're just fast. But it's still good progress nonetheless. Now, where I think it's very different here is that you don't have that comprehensive framework in the US to work with, but that has also created an opportunity for products to really accelerate. So for example, I would say we definitely have more advanced regulation in the UAE, but we don't have more advanced product. and the product output is coming still from this part of the world for the most part.
But it's a conundrum. I mean,
Yeah.
quite frankly, if you are an innovator, you run the risk of basically creating a footfall with the regulator after you've built your product. Yeah, so you welcome the regulator into to audit and look through your processes, and then wait, and you could easily be a target for an infraction.
But the other issue is like if you're a founder in US, right? You don't know which regulator you're bind under. Are
Right.
you under are you under SEC or CFTC? We're registered
both.
under both or both, or FINRA or what is it, BSA? I'm forgetting.
OCC could be, yeah.
It could be, and there's no clear guidelines. Now, DeFi gets away because they say, look, it's all on-chain, good luck catching us. But then who are they able to catch on there? The people that are insider trading, right? Fine, old hack that has been truly tested in TradFi. NFTs, same thing. What are these images up on-chain? Who are you catching inside trading? So it's not many, like a lot of clear guidelines. And even when you put so I deal with like KYC and AML for the fun. And there are days when I just want to shut down my computer because I see funds like Three Arrows getting away with like $10 billion. And I am so sure they had their quote unquote formation documents lined up, but they never had audited financials. And then, crypto players like let them get away with it for whatever the reason was. So it's, again, that we've seen that also happening. So what is the truly outcome? Like, does Gensler say, okay, fine, we become that one agency that are truly going to regulate? But what are they going to regulate? Are they going to regulate the function of USDC, or ban Tether, or come up with their own coin? It's just a conundrum. And one thing I just wanted to add, so we've had the pleasure of getting regulated in Singapore, MAS, right? And they're quote unquote one of the friendlier regulators. When I was doing their paperwork, they don't acknowledge anything other than Bitcoin, ETH, and USDC. They don't even look at Tether. And Three Arrows was incorporated there. And now they've literally paused on all of the applications that are pending in the system because they're saying we did our due diligence so much on them and these guys got away with as much as they did.
Basil, I think you brought up a really good point, and that is the notion of self-regulation. I do think it's incumbent upon most players in the ecosystem, whether you're a fund, to apply some of the standards of risk management, disclosure, audit, to your processes and be clear about that. And that in itself can be a form of self-regulation in advance of what regulation is. And so I do think that that's part of also crypto growing up. It's absolutely critical. To be candid, I don't think it's possible to raise funds without audited financials at this point, and a transparency around what your strategy is, and a definable strategy, not three guys in a room spinning a wheel, picking the token of the day. It is literally like, we did the analysis, we understand the token economics of this asset, we understand the network health of this asset, and we have an investment thesis. It's really not a momentum play anymore.
We've got just a few minutes left. I thought we'd loop in the news of the day today. Charles Schwab, Fidelity, and Citadel launching their own exchange. To what extent do you think that the decision to launch their own exchange is, tied to them wanting to do things on their own from a compliance perspective, or putting pressure on regulators and saying, hey, we're just going to do this ourselves, and we've arrived now? Christine, I'll put it to you first.
Well, it's familiar territory. So it is, these are market makers that are experienced in terms of handling retail order flow and intermediating that, and running profitable businesses, as well as, then you have those distribution channels that actually have that retail order flow. It is, it's a tried and true business model. And it's something that has come under fire in traditional markets of late. So the payment for order flow mechanism doesn't exist anywhere else in the world except in the United States. And there has been kind of a pretty significant push-pull. It makes complete sense for these entities as they approach this space to test and use this model that is very familiar to them.
Ayesha, any thoughts?
Retail protection, I think they'll do a better job than most of the crypto exchanges out there. They know it. They know their investor base. Yeah.
And from the retail side, what they want is certainty of execution. They do want the ability to actually, if they have large amounts of retail flow coming in, that they'll get quality execution.
I mean, I'm not going to name exchanges, crypto exchanges, but a couple of them have managed to ruin their reputation way much more better than anticipated this year. So if Schwab wants to pick up their tabs, please do it, because it's all about adoption for us, right? So more venues for us to market made, we'll do it. But yeah, I think it's a lot more secure venue than anticipated.
And just very quickly, we've got 59 seconds left. Just down the line here, the merge is happening this week. Where is ETH going to be by the end of the week? Ambre, up or down?
Up.
Up?
Flat.
Flat?
Down.
Down?
No, I love ETH. I was a very early employee
it
at
was
Consensus. I love ETH,
it was just
but-
a one word, up or down or flat.
But before walking in here, I saw market data. The entire market is looking to short it with like Delta hedged. So.
All right, so we've got up, flat, down.
Regulated exchange, I have no opinions.
And there you have it, folks. Thanks for joining us. I think we'll keep it at that.